contact a quantity surveyor, send them your property address. With realestate.com and RP data and price finder, we can see photos online, so we can do desktop estimates, and every quantity surveyor is going to do that for free. So I encourage people to reach out to a quantity surveyor and even better, maintain a relationship with one, because it can be very helpful for making sure you're getting what you want out of your investing journey.
We believe every Australian deserves a right to own at the very least 5 investment properties. I'm Adrian Trimboli.
And I'm Frank Ambezi, and welcome to the Invest in You podcast. No one achieves great things by following the crowd. Have a spine, strike your own path. So this is a quote by Robert Kiyosaki. Now, it kind of resonates a little bit with today's topic and what we're going to be discussing. Now, if you follow the crowd, you'll get the same results as what everyone else in society is getting. Now, majority of people don't get what they want because they follow other people, follow other crowds. And now this has an effect on your life, because you're not chasing something that you truly want in life. You're following someone else. And if you want something bad enough in life that resonates with you, resonates with your core values, you have to do things that don't revolve around following other people. It's about you chasing your own dreams, or desires, or whatever you want in life because you want it. And today I want to do this quote because there's a lot of things when it comes to property investing that a lot of people will follow the crowd. They'll follow the herd and they'll get the herd results. Now, statistics don't lie. 99.6% of Australian investors don't own more than 3 investment properties. There's only 0.4% of Australian investors that own 3 or more investment properties. So the statistics don't lie. Now, for you to get a different result, you can't follow the herd. You have to go down a different path. You have to get the shovel and dig your own path. So I wanted to do this quote for today. Now, I want to introduce you to a special guest that we've got coming on today, who is a depreciation expert. He's a quantitative surveyor. His name is Mr. Mortlock. He is the co-founder and director at MCG Quantitative Surveyors. He's got a great podcast himself called Geared for Growth. If you haven't heard it, I highly recommend going to the podcast app or Spotify, if he's on Spotify as well, and watching or listening to his podcast. He's got a great podcast all about property investing and all different people from all different industries that revolve around property investing or just property itself. Now, he's got a wealth of knowledge when it comes to depreciation. So if you don't know what depreciation is, it's a strategy. It's not a strategy. It's a getting a quantity surveyor report done on your property, and which you're claiming the fixtures and the fitting and the building structure. Okay. Now, I'm not going to talk too much and explain what he does exactly, but if you want to learn and understand about depreciation, how you can lower your taxable income, pay less tax and get a tax rebate, this is the episode for you. Okay. So Mike, like I said, he's got a wealth of knowledge. He's an expert in this field, and we use him for our clients. We refer our clients to him because he's got the same level of transparency, and we love the way he works, of course, and the level of service he gives to his clients and our clients and all the other Australians that do use his service is amazing. So stay tuned. This is something that majority of Australian investors don't know about. They do not know about depreciation. So stay tuned. Listen to this podcast. It's going to be impactful. If you don't know anything about depreciation, you're going to learn something new today. All right, Mike, you want to introduce yourself, I guess, to the viewers or listeners, a bit about yourself, MCG Quantity Surveyors, and I guess what you guys do.
Yeah, that's a good question. Get that a lot at barbecues, and people normally walk off mid-explanation. So my name is Mike Mortlock. I'm the managing director of MCG Quantity Surveyors. I'm a quantity surveyor, which makes sense. So we're specialists in construction cost estimating. My particular area of expertise is in the tax depreciation side of things. So helping property investors maximize their cash flow through their tax deductions, and that's residential, industrial, agricultural, the whole sort of gambit. And we started MCG back in 2011, myself and Marty Sadlier, who's more of a traditional cost estimator working with developers and financiers, just on the basis of that I guess we're arrogant enough to think that we could do it better. And just we're sort of, I guess, excited by the idea of running our own show.
Beautiful. So the catalyst of you going down this route, was it something that you've always wanted to do at high school, or was it something that you seen that there was I guess a hole in this industry and you wanted to patch that up?
I think it'd be weird for me to say that I always wanted to be a quantity. I always wanted to be a fighter pilot. So like I missed just by the smallest of margins. But I guess my sort of personal background is that I did want to be a pilot. I had some medical issues that meant that I was never going to be selected. And I was doing the HSC part-time, so I did year 11 and 12 over 3 years, and I had sort of a bit of a time gap, and I thought, well, I'm going to have to spend something on my time, or spend my time studying something. And I was always interested in real estate, so I became a real estate agent for about 10 glorious months, and then I realized that being an introvert sort of data person, it was not the job for me. So I actually studied valuation and then got a job with a quantity surveying firm, and they convinced me to move my credits over. So I did really like the property side of things, but much more the sort of the analytics of property rather than doing the sales side of things.
Well, okay, there you go. So that's where it all kind of stemmed from there. So with, I guess, depreciation, because we get a lot of listeners, a lot of viewers, they're kind of just starting out with their property journey. To give them an understanding, what is depreciation, I guess, and what you can do with that report. I think people think you can just claim your your deductions or your expenses at tax time with your accountant. So you get your rates, you get your other utilities, you get your maybe some repairs, you give it to your accountant, and you just write it off at tax time. But a depreciation report is quite different.
Yeah. So a depreciation schedule is essentially a report that shows the deductions that you can claim each financial year from your date of purchase through 40 years, whether there's deductions in 40 years' time or not. That's just really the standard length of a report, because really the maximum life of the sort of longest running component in a building is 40 years. So it's going to be broken up into two components. It's going to be the building structure. So if you think about all the hard stuff in a building, like your timber and your concrete, those sorts of things. And then it's the plant and equipment items. So carpets, blinds, kitchen appliances, hot water systems, those sorts of things. Now, there's a couple of different nuances about which items qualify based on the age, but in essence, it just calculates what the value of those items are when you either build the property or purchase the property, whether it be old or brand new. And then the tax office gives us a statutory depreciation percentage that those assets decline in value. So if you think about it this way, if you're renting out, let's say, a brand new property, the tenant is walking on your carpet and it's wearing out over time, right? And because you provide a service really to the tenant and to the country, because the country's sort of out of the public housing game these days, owning, I think, less than 5% of private rental stock is government owned. They're allowing you to basically say, well, the amount of money that carpet is going down in value because of the use is actually going to be tax deductible. So there's a set percentage each year, and we work that out. And the net result is, in one particular year, it might say that you've got $11,000 worth of tax deductions, and that comes off your taxable income. So if you're earning $100,000 a year, in the eyes of the tax office with our schedule, you'll only be earning $89,000 a year. And the difference in tax payable between 100 and say 89 grand is around about $4,000. So that's the value of a depreciation schedule.
And so that will last, depending on the particular age of the property, for a certain period of time. That's correct.
Yeah, so things like carpet have and plant equipment items have a dedicated effective life, and they're all sort of different. So carpet is 8 years, for example, whereas the building structure, really all of the items last 40 years. So that's really the maximum sort of life of the schedule. But if you think about it this way, if you buy a property that's 10 years old from your purchase, your report will go for 40 years, but there'll be sort of 10 years where nothing is in there. However, if you renovate the property, say 20 years after purchase, it'll actually end up going 20 years, further into the future. So it'd be 60 years you'd be able to claim the deductions. But I suppose we've got to have a cutoff point where the reports don't get too ridiculously long. So the industry standard is a 40-year report.
Oh, okay. Then so for the viewers, I guess, or listeners as well. So it doesn't really, the age, I guess, is up to 40 years. But if there is a renovation or the property's had something done in after those 40 years, you can still claim a depreciation on the fixtures, fittings, and as well as the the structure of the property if it's had any significant.
It's a really good question, Frank, because people get quite obsessed about dates and whether it's worthwhile getting a depreciation schedule done. I came up with 3 triggers to sort of help easily answer this question. So there's 3 things that you would need to satisfy individually. You don't have to satisfy them all together to justify whether a report should be done. The first thing is you buy a brand new property. That's an obvious one because it means you can claim the original structure and the plant and equipment items. The second scenario or second trigger would be the property's built after 1987. So the 16th of September 1987 is the cutoff date for claims on the original building structure. So what was built when it was built. So if it's built after 87, you'll be able to claim 2.5% of the structure of that property. So let's say it cost 100 grand to build the structure in 1989, you'll get 2.5% of that, so 2,500 a year worth of deductions. Now, depending on your marginal rate, depends what you get back, but that could comfortably be, $800 or $900 back in your pocket. The other scenario is it's not brand new, it's not built after 87, so it's an older property that's maybe built in the 60s or the 70s or even in the 10s, which we've seen, but it's been renovated either by the client or the previous owner. So when people say, and even quantity surveyors say this, they say new property is better for depreciation. As a general term, you could say that that's okay, but it's not absolute because we've done properties that were built in, say, 1910 that have had $2 million renovations done in, say, 2020 by the previous owner, and they're now sold, right? These properties are smashing the deductions out of the water compared to a brand new project home. So hopefully those sort of 3 triggers make it a little bit easier for investors to understand when they would benefit from a schedule.
Yeah, for sure. And I think people shouldn't just purely, I guess, purchase new properties just for deductions. I guess building wealth through property, you're using it as it's a necessity, I guess. Would you kind of agree on something like that?
Yeah, because people will ask me from time to time, what should I buy for the best deductions? And then I go on to explain in their head what is the worst possible investment that they could buy. And they're quite surprised because I would say, all right, well, for deductions, if you want them to be the best, you want it to be a unit. You want it to be in a complex with as many units as possible. So let's say 400. You want it to have 6 basements, let's say 2 gyms, 3 swimming pools, a cinema wouldn't hurt. All of these things that are going to make your strata fees just terrifying. And of course, when you're buying in a complex like that, you put the property up for rent, you might be competing with 10 other properties that are identical for yours. So there's no scarcity. The same when you sell the property. So depreciation is not a strategy. It's a bonus. People certainly go into property investing with the goal of minimizing their tax. I think that's a flawed idea. We definitely tend to fear the stick more than we sort of love the carrot, if that analogy makes sense. But yeah, depreciation is really just a bonus, and it can be a great thing. It can turn a negatively geared property into a positively geared property after tax, but it shouldn't be the main reason why you're selecting one property over another.
Beautiful. I guess for a personal situation, have you ever, I guess, purchased a property where you not claiming any deductions yourself?
Never, no deductions, but I did buy a property that was built a year before the cutoff, right? And as a depreciation guy, it was kind of devastating. I was like, oh, this is so close to being, an extra 2 or 3 grand a year worth of deductions. But I have to listen to and remember my own advice. Depreciation is a bonus, not a strategy. And the property metrics, they stacked up on their own. So it was enough to sort of make me annoyed, but not enough to change the strategy. But see, with that property, it had improvements. It had some updates and some renovation. So if you think about it, a property that's built prior to 1987 left in original condition is quite rare, because there's no benefit to the owner. They're going to attract a worse quality of tenant because it's out of date. It's not going to do well if they're wanting to revalue it and pull out equity, because the valuation is not going to be as good as it would be if they did a renovation. You think a property built in, let's say, 1985, you put a $40,000 renovation into it, you can assume it'd be fairly safe to say you're going to get double that back. It could be 5 times that back, and things just wear out over time. So in most cases, we will find that these older properties have got enough in it for us to justify a report, and by justify we mean it's going to give you back more than what it costs. We don't do reports unless they're beneficial for the client.
Oh, beautiful. I guess that's good for for your clients, and I guess all the other people using your service. And it's kind of like, it's like a light bulb moment there as well, because it's a bit like marketing or for your business and for your, I guess, attracting the right tenant. So always keeping that upgrade on that property, which I'm, a big advocate for, because if you don't, you're going to attract the wrong tenant as well. You're not going to get the best price if you want to go sell the property. So it's always, you look at it as a strategy as well, as to improve the quality of the property and the tenant, and vice versa. So very true. So I guess when it comes to depreciation, what's the average, return or the deductions that the Australians will get? Is this something that, at MCG, you guys have done like a survey and gathered all the reports and see, okay, on an average, we're helping Aussies get a deduction of X amount?
Yeah. When we started, I saw a real gap with other industry participants in the tax depreciation space. The kind of conversation was always around, on average we get $5,000 to $10,000 worth of deductions, and that kind of annoyed me. That sort of seemed lazy. It was like, well, that's not an average, that's a range. So from day one, we were collecting the data on those deductions. Now, when you've got a sample size of say 20 reports, because you're a brand new business, no one wants to hear from you, right? So we had to be a little bit patient to launch this figure on the world and the media. But the first time we did it was $9,183, and I remember that for a long time, just because that was the first time I think anyone had ever actually said that. So it changes every day. We're actually tracking this live. We have an internal dashboard that we may unleash on the world at some point. But it just depends on the properties that we're doing, the locations, whether we might do a day of reports and they're all sort of newer properties. But between that $9,000 and $11,000 is where it normally sits. So 9 is probably good as a conservative estimate, and depending on your marginal rate. So if you're on the 37 or 45 percent market, it could be $3,500–4,500, probably $3,500 to $4,000 back in your pocket, and that's in the first full year of claim. So if you're renting it out longer than that, you'll get the benefit of those future deductions as well.
Okay, so if I want to paint a picture here for the viewers and the listeners, so if you just say you can write off $5,000 of your taxable income this financial year and you've just purchased your investment property, is that $5,000 directly going to come into your bank account, or does that how's it work?
Yeah, so no, it's a deduction such as your sort of deductions for work. So if you buy a laptop or a uniform or sun cream or whatever that's relevant to your work. Whatever you earn in your pay packet in the eyes of the tax office, the deductions come off that amount. So if you earn, say, $50,000 a year, you, without any deductions, you would pay your tax on 50 grand. But if you have $5,000 worth of deductions, you're paying tax on the $45,000. So that's how depreciation works. It is a deduction in the same way that visiting your accountant is tax deductible. You know, you hear about charity donations as tax deductible. So that's really, it deducts from your taxable income. So if you donate $200 to charity, you don't get that back, but your income will reduce by 200. So then, you know, based on your marginal rate is what that difference makes for you, if that makes sense.
Yeah, it does. Okay. And so with, I guess, because I know from personally, my uncle, he owns a fair few properties and he's never even heard about depreciation at all.
Oh
And
dear.
it's quite astounding. He's just leaving so much money on the table. You know, like I feel like there's a large number of Australian investors that, you know, that probably don't know about depreciation. Is there like have you done a tally on that to know exactly how many, the percent formula of guess how many investors are leaving that on the table?
Yeah, it's a hard question, and quantity surveyors have tried to do that before, but they can only really look at the ATO tax stats, and they say, okay, well, you know, there might be 1.3 million property investors, and our average is, say, $9,000 worth of deductions, but we can see the average claimed is 4,500. The methodology is flawed because after a certain amount of time, deductions will go down and they may even run out. So it only kind of works if everyone bought their property straight away. So there's no clear way to say how many people aren't claiming deductions. The best that we've been able to do is that we looked at a sample of 1,000 residential property purchases that came through our doors. And what we found is that 6.7% of them waited so long to get their depreciation schedule, they actually missed deductions. Now, to put that in context, you can back claim 2 financial years worth of deductions. So you could go to your accountant and say, I've got my report done. The last 2 years, I didn't claim any deductions, but I've got this depreciation schedule, and your accountant can charge you a fee to amend those previous returns and recoup those deductions. So we're talking about 6.7% of investors waited more than 2 years. So we can tell from their settlement date to the date that they contacted us was more than 2 years. And the average amount of deductions that those individuals lost was $20,537. Now, if we extrapolate that over the investor population, that's over 130,000 investors, and it's $2.88 billion worth of missed deductions. So I see those numbers as very significant. And what I think you've got to keep in context with that data as well is that these are people that somehow figured out that they need us, right? So they came to us eventually. They just came to us late and they missed deductions. So there'd be people out there that just don't know. They don't realize. They don't listen to your podcast, Frank, when you have people like me droning on about the advantages of depreciation. So your uncle is in possibly very unfortunately in those statistics of the missed deductions. And I think what you should get him for Christmas is a business card to a quantity surveyor.
That's a good idea. Actually, I might have to give him your card there, and you can come see, because you know, when you got 6 or more properties, it's you're leaving a lot of money on the table. That's so that $2 billion, that's going straight back to the government,
Yes,
basically.
and like I tend to make a joke about that. Like if you want to donate money away, give it to someone that's going to use it a little bit better. Like, because my original joke about this was the Collins class submarines, right? We bought all these submarines and they were duds. Now that was probably a joke that I was doing, 7 or 8 years ago. Now it's the nuclear submarines, right? So do you want that money to go to the 8th nuclear submarine that's going to upset the French? Or do you want to give it to your charity? Or do you want to put it back into your own wealth creation journey? I think a lot of people will think, if I'm going to be giving money away, it's probably not to the federal government. They do some great things, but they also waste money.
Yeah, for sure. So I guess if people are listening and they've got property here, reach out to Mike, reach out to a quantity surveyor, and, because you're leaving money on the table. That's something I think majority of Australian investors are missing out on. So if we come back to, I guess, let's say I want to do a renovation to a property. Now, do you think it's wise to speak to a quantity surveyor to make sure we're putting in the right fixtures and fittings so we can get, I guess, we can maximize those deductions as well?
I think so. The reality is that no one really ever does. I've written a couple of blogs about this, and probably the easiest way to explain it is that when you're doing a renovation, if you don't necessarily care too much about the materials that you're putting in there, there are certain things that you can tweak that result in a much better tax outcome. So, say for example, carpet. If you're putting carpet in the flooring, in the floor areas, you're going to get a 25% deduction each year based on the carpet that you chuck in there. If you decide to put carpet instead, you're getting a 2.5% deduction. So it's actually 10 times more beneficial to put carpet in a reno than it is tiles. Now, over 40 years, it's exactly the same, right? So if you spend 2.5 grand on carpet or 2.5 grand on tiles, it's the same deductions over the life of the property. But the real benefit in the plant and equipment items like carpet is that you're front loading those deductions. So you're getting that, you're getting 2,500. You'll be getting 25% of your 2,500 in year one instead of 2.5% of your 2,500 in year one. So it's 10 times better. Now, the value of a dollar today compared to in 40 years' time is going to be much higher. So you're bringing that forward has a real financial value, even though it's the same over 40 years. And I think when it comes to investing in property, sorry, my lighting's going a bit dodgy there. I'm at home due to this whole COVID situation. The other point, when it comes to front loading those deductions, is that really the hardest time to hold on to an investment property from a cash flow point of view is at the beginning, because over time you might be paying your mortgage down, so your repayments drop. But even if your principal and interest, hopefully over time your rent goes up. So it should get easier to hold that property as time goes on, as it goes up in value, or rent goes up in value. So it's better to get those deductions now rather than in the future, in my view.
Yeah, for sure. Okay, then. So yeah, that would be something, a little bit wise. Maybe even you have to speak to a quantity surveyor. Has that ever happened in previous
I
history?
mean, I've had the conversation with people, but more as sort of like they were mentioning they were doing a renovation, and I sort of asked them some questions about it and got a few light bulbs from people. But yeah, there's certain things, and floor covering is probably the biggest one. There is a difference between vinyl and floating timber and carpet and tiles and polished concrete and just standard timber floorboards. They'll all depreciate in different ways. But the tax outcome of a renovation is probably not in the front of people's mind. It's more about what's my equity uplift going to be, or how much more rent can I charge, or when are these bloody tradies going to show up.
Yeah, there's a whole bunch of things there, isn't there? Is there? I guess. Is there anything else you would like to touch on, Mike? I guess we've covered a fair bit here, but being you're the expert in this field, is there anything else you kind of want to give to the viewers or listeners?
I think, in all honesty, as much as I'm kind of flogging my own stuff here, I always kind of say, and this is maybe being a bad business person, but if you don't use me, use somebody, right? So I'm a quantity surveyor. You can contact me, and I'll look after your depreciation stuff. But um, I just implore people to have a conversation with the quantity surveyor to see what deductions are available. And I can talk for hours and hours about the nuances of tax legislation and ATOIDs and all sorts of things like that. But I think the most important thing is those three triggers. If it's brand new, if it's built after 87, or if it's older than that and it's been renovated, over sort of 40 or 50 grand worth of renovations makes it a safer bet. I just think contact a quantity surveyor, send them your property address. With realestate.com and RP data and price finder, we can see photos online, so we can do desktop estimates, and every quantity surveyor is going to do that for free. So I encourage people to reach out to a quantity surveyor and even better, maintain a relationship with one, because it can be very helpful for making sure you're getting what you want out of your investing journey.
Yeah, for sure. Well said. I guess, look, I don't want to, you don't have to say you're flogging your stuff, because I think this podcast, we're trying to help, Aussies, I guess, get the most out of themselves and their, I guess, their property portfolios. So, invest in you. That's what we're all about here. And I think you don't want to be leaving that money on the table. Like you said, you've done your calculation there. What, $2 million is going back to the government. So I think Aussies do have the right to, claim those deductions. So that's what this is all about. Before we get close to the end, I know we're running out of time now. I want to talk about, you've got another service as well. So for insurance, so
Yes.
valuing the property, getting the right, correct insurance, so you can cover the building if something does happen. I want to talk a little bit on that, because I think that's really, really important. That's a bit of a hole as well when it comes to insurance policies.
Yeah, it's kind of a passion project for us, and we've created a flat fee of $600 plus GST for all property under $10 million in value. So that includes the vast majority of commercial properties that people own, as well as standard houses. Insurance Council of Australia came out with some research a couple of years ago saying that 83% of homeowners are underinsured. Now, given the recent increase in construction costs due to the pandemic, those numbers are going to be a lot higher than that. So a lot of people don't realise that when you're insuring your property, there are some costs that go into it that don't sort of spring to mind. I can remember in a decade or two ago, looking at, say, an ad for let's say it was a Masterton home, and it was, like 200 grand. I'm like, that's way better than mine. So if I insure mine for that, then that'll be fine. But what happens when there's damage to the property, especially extensive damage, is that the property needs to be demolished. So there's a cost involved in that. It doesn't always leave like a flat, nice site ready for a builder to go in. There's cost escalation. So costs go up over time, and even over the construction project as well. You might find that what's built on your property is actually not compliant with the council anymore. So it might be too close to the boundary, or there might be some legislation that says you've got to have water tanks or different windows because you're close to a bushfire zone and things like that. And there's the costs of the consultants and the tendering and all those sorts of things. So those are some of the things that people don't understand. And yes, so we do replacement cost estimates for insurance. They're not valuations of market value. And this is another point. Property valuers will do a valuation, and they will put a replacement cost value in it. In our view, they're not qualified to do that because they're not construction cost estimating experts. We're not qualified as quantity surveyors to do market valuations because that's a different area of expertise. By the same token, they're not qualified to estimate construction costs such as we are. So they will actually put a disclaimer to say, a quantity surveyor should be sought if you're wanting to rely on this. Another point to make is that the online calculators are really run by the insurance companies, and they are really only interested in having a nice, smart, little, easy tool so they can get your policy through. We've done some research on those calculators. We looked at 5 of them based on a project that we actually were involved in. We knew the construction cost, and the variation was massive over that. It was over 30%, across the different calculators, and that makes a really big difference. So I would encourage everyone to consider that the insurance value of the property is just not something that you should bung into a calculator, because Mother Nature seems to be getting angrier and angrier each year with global warming. We constantly see bushfires, year on year. There's a lot of people losing their homes in storms and having the damage. The worst thing that can happen is if you go through that trauma of having your home destroyed, you'll then realize that you're going to get a tap on the shoulder from the bank or from the insurance company to say, you're going to need to chip in on this if we're going to establish something here for you.
Yeah, for sure. That'd be pretty terrible as well, seeing someone go through that and then not be able to cover that home, which it probably happens a fair bit. So I guess you're doing a service there to try and help, I guess, people with that sort of, with their policies as well. So which is amazing. It's good. You're a very fine entrepreneur that's trying to, find solutions to help people and I guess, so they can help themselves and get the most out of their situation, which is amazing.
Well, I think it's very kind of you to say. I'm not clever enough to save babies or anything like that. So I'm just a construction estimating tax guy. So whatever we can do to help. I mean, everyone wants to think that they're providing value and doing right by people. So, that we're really passionate about that, helping investors to maximize their deductions and protect their assets as well.
For sure. So, Mike, I guess, look, I've got one last question. Well, I've got two actually, but would you make a property investment decision purely on depreciation?
No, I think we went into a bit of detail on the
Yeah.
why before. I think people definitely make decisions based on the tax position. Maybe not so much depreciation, but it definitely factors in. I definitely get the question. People might say, which is the best property for depreciation between these two? And they're fundamentally similar. So you can sort of tell that they're considering it as a bonus. But if they're sort of saying, okay, well, I want to buy something that's negatively geared because I'm paying too much tax, I think that's the real wrong approach. If you're investing in property, I assume that you're doing that to really change your financial future, which might mean retiring early. It might mean donating to charity, spending time with your children, flying around the world, doing whatever you want, right? Unless you're a believer in reincarnation, you only get one go at this, right? So it's pretty serious. So I think people that are just sort of looking at it in terms of I'm paying too much tax, it's a short-term pain that you're focusing on, and really, especially with property investing and business, if you're paying tax, it's kind of it's saying that you're doing something right, you're making money, right?
For sure. Very, very true. I guess the more you pay in tax, it's a good thing. It's a good problem to have.
Yeah, of course, minimize it, right? But just trying to come up with strategies to get rid of it that don't necessarily serve your long-term goals and aren't sort of focused in properties that will go up in value and create real wealth. That's a bit nearsighted.
Yeah, very true. So I guess, look, if people need to get in contact with yourself, where can they find you?
If you can spell my last name, I'm pretty easy to find. So I'm
You're a
I'm on
celebrity, Mike,
Facebook.
aren't you?
What's that, sorry?
I said you're a celebrity when it comes to property in this field.
Yeah, it's like being the world's most famous beach worm fisherman. A lot of people will have heard of you. Yeah, you can find me on Facebook and LinkedIn, and I think I'm on Instagram as well. No TikTok yet. So Mike Mortlock or MCG Quantity Surveyors, and certainly with MCG, jump on the website. We've got all sorts of things available for investors. You can search through your suburbs to see property metrics. We've got a depreciation calculator. We've got a rental loss index that can be part of your due diligence as well. So there's a few sort of things in the show bag for investors there for free.
Few little goodies there, by the sounds of it.
Exactly.
Beautiful. I'll put your show notes in, your details in the show notes as well. So if anyone wants to reach out, just reach out to Mr. Mike Morlock or his team, and they'll look after you. But it's been a pleasure, Mike. You've got abundance of knowledge when it comes to depreciation, and we appreciate it.
Cheers, Frank, and I appreciate you, going to the effort of putting this sort of stuff in front of your investors. You're obviously passionate about what you do, and it's a nice partnership there. So always a pleasure.
You're welcome, mate. Thanks again. We'll keep in touch soon.
Cheers.
All right. Have a good day.
You too.
Ciao. So there we have it. Mr. Mike Mortlock. He's got abundance of knowledge when it comes to tax depreciation. Now, a few little sneak peeks, So if we go back and recap on today's session, Mike stated that you can claim up to 40 years of depreciation on the fixtures and fittings and the building structure. Okay. Now, this is on, I guess, if it's a new property, you can claim those fixtures and fittings and building structure. Of course, if the property's had a renovation as well, during that period, you're going to be able to claim those deductions. And even if the property is older than 40 years, but it's had renovations, up to $40,000 to $50,000 more, you're going to be able to claim those deductions as well. So don't think your property's not old enough, or sorry, it's too old and you can't claim those deductions. You can still get, I guess, a quantity surveyor to check out the property and to see if there's any life in those deductions as well. So making sure you're not leaving anything on the table, because look, by statistics, what Mike was going off, there's a large number of, I guess, property investors that aren't taking advantage of, depreciation, solely depreciation. And I think there's a large number of, I think it's nearly $3 billion that is going back to the Australian government, because they're not taking advantage of those deductions, which is massive. So I think on average with the research he's done, he average there was $9,183 people are averaging what they're reducing off their taxable income, which is a lot of money for everyone. So I think taking advantage of that, it's helping you lower your taxable income, getting those tax rebates. It's going to help you accelerate your property portfolio. But like as we mentioned, you were using this as a necessity depreciation. It's not, I guess it's something that just look at investment in property as a tax benefit where we want to build wealth. And I guess depreciation is the necessity what it comes with. So if you're getting something and it's a high quality property in a good area that's going to grow, it's cash flow positive, or it's going to it's going to help you accelerate your journey to achieve those goals, but as well it comes with that depreciation, that's a bonus as well. So remember to keep that in mind. And as well, I guess making sure if you're going to do a renovation, just having a think about what fixtures and fittings you want to put into the property because of those, maximizing the depreciation. That can be another little sneaky tip as well. So if you want to get in touch with Mike, I'll put the show notes I'll put his details in the show notes. You'll get access to his website and his phone number, of course, and he's all over social media, Facebook, Instagram as well, and LinkedIn. Just look up Mike Mortlock and he'll put you on the right path. So thank you for watching this or listening or watching this podcast, and we appreciate it.
If you like today's podcast, then you're absolutely going to love the Invest in You Facebook group, where we share a bunch of valuable tips and tricks on property investing for our exclusive community. Come join us and let's level up.